afternoon, everyone. Welcome to another episode of Coffee with Carl. I'd like to introduce our guest today, Samuel Rines, a microstrategist at WisdomTree. He brings over a decade of experience in economics and finance, with past roles including chief economist at Avalon Investments and managing director at Corbu. He's also the author of After Normal, Making Sense of the Global Economy, and holds advanced degrees in economics from UNH and Oxford. We're excited to have him today, and it's perfect timing. He's going to provide some insights and updates on the international markets. So thanks for joining us, Sam.
Hey, thank you.
Yeah, thanks, Sam. I know, obviously, as we started in that prelude, a lot going on with everything with Iran, Russia, and then certainly, the fallover from how China may deal with things into the future, and obviously Russia, adding into the news. Love you maybe to just unpack, what you guys are seeing on your end, maybe high level, for the folks on the call. And then we can probably take a further step and dive in maybe on a country basis on how this, how this will affect each of these individual countries.
Sure. And so kind of to frame the broader discussion, I'm a pretty big believer that having a framework that you can function within going into events like we've seen over the past couple of weeks, or the Russia-Ukraine conflict, or tariffs and trade, is really, really important. It allows for parsing through the noise and being able to make better decisions, right? It takes a lot of the emotion out of things and really provides a roadmap for how to mentally kind of deal with what we have to go through as investors and as people every day. So I like to start with the Russia-Ukraine conflict in particular, and delineate that from what is and was going on until, call it last night, with Iran, Israel. And we divide it into two baskets, broadly speaking. We divide it into short-term shocks to the system from geopolitical events and geoeconomic events, broadly the same thing, and long-term economic shifts. Those two things are wildly different in terms of their implications for investors and portfolios. What we saw with Russia-Ukraine was a long-term shift in the economic framework of the global economy. Russia, after the fall of the USSR, now Russia, after the fall of the Berlin Wall, had slowly and steadily kind of reintegrated itself into the global economy. The US had a little bit of sanctions on Russia, but nothing major going into the invasion of Ukraine. Then all of a sudden, sanctions from the Western world really began to fracture what was at the time the second largest producer of oil in the world, right? There's the US, there's Russia and Saudi. They kind of oscillate as number two, number three. And then there's really everybody else kind of way down the list in terms of importance. And when the Western world began to say, hey, we're going to put a price cap on your oil, we're not going to take your nat gas, we're going to sanction this part of your economy, that part of your economy, it began to really create rifts in the way that the global economy functioned. Northern Europe struggled, electricity prices spiked, and that was really something that was necessary to take into a longer term consideration for portfolio allocations. Europe did not do well after that for a while. It's made a comeback recently, but it took a long time. It took the US beginning to send a lot more liquefied natural gas over to them, a lot more Qatari liquefied natural gas, et cetera. It just took a long time to really rework a significant portion of the global economy. The Iran-Israel conflict is much different. It's much more of a short-term shock. And I was preaching this to people internally at WisdomTree. It's a short-term shock. Iran exports something like 1.5 million barrels of oil predominantly to China. 1.5 million barrels is about half of the spare capacity of Saudi Arabia at this point. Saudi Arabia and the US are really close friends. Iran has been sanctioned out of the Western world for the better part of 40 years. It's simply not deeply integrated into the global economy, unlike Russia. So any sort of short-term spike in energy prices, any sort of shift within the way that we think about any way that we think about the world was really going to be temporary in nature. And it was time to, kind of begin to say, ooh, I really want to allocate a little bit more to this equity or that equity market, or this could be really interesting, because it sold off on an energy spike. And, maybe I want to look over here for something that I want to hold for the next 3 to 5 years that people are blowing out of a portfolio for no reason whatsoever. So that's really the way that we try to have a workable framework for when things happen, instead of knee-jerk reaction. We want U.S. dollars, or we want to be overweight bonds, or this, that, and the other thing. It's really taking a look and saying, is this a long-term structural change for the global economy, or is this some sort of short-term shock that we might want to take advantage of, but we don't necessarily, think you have to completely rework a portfolio to deal with. So broadly speaking, that's the kind of the framework that we function within. There's a lot of details within that are nuanced, and if it, there's other types of conflicts that, maybe oil doesn't spike, maybe gold does, maybe the dollar does something, and there's different aspects to it. But we generally function within the kind of those two buckets. Which bucket does it fit in, and how do we give good advice to clients, and how do we give good advice internally on structuring our own funds?
It seems like you guys were really considering it's like almost like a non-event in the near term. I mean, would there be any catalyst that would kind of push that the other way, where you guys really start to get a bit concerned about maybe oil price and the effects of that, et cetera?
The only real way that we would become significantly concerned about a conflict in the Middle East is if somehow the Qataris and the Saudis were involved. The Qataris are very important for the liquefied natural gas market, and therefore Europe. And the Saudis are very important for the global energy markets, just more broadly. But Saudi really doesn't like Iran, and the Qataris and Iranians get along pretty well, and the Qataris and Saudis get along pretty well. So there tends to be, I would say, more of a mechanism to dissuade each other from getting involved in broader conflicts among those three. So to us, it would take some sort of almost an accident, right? That Iran accidentally sends a missile, or the Yemenis accidentally send a missile that was aimed probably at Israel, or somewhere in that region. And it accidentally hits somewhere in Saudi Arabia, particularly energy infrastructure. That would be the only thing that would really catalyze us to be more concerned about it. But we would be more concerned about it on a 2 to 3 month basis. We wouldn't be concerned about it on a longer basis than that. It's very hard to have Middle East conflict at this point really concern us more broadly. We'd be concerned about on the margin growth in China. China is the primary buyer of incremental oil out of the Middle East. But the fundamental change over the last 30 years is that the U.S. is almost insensitive to oil price shocks. Even if they spike above $100, it tends to it hurts the consumer on the margin, it hurts industry on the margin, but it really benefits a large portion of the southwest of the U.S. at this point.
Do you guys see any likelihood? It seems like this is probably already past it, of them trying to close down the strait, because I know that would obviously affect them directly, and they would probably piss off the Chinese quite a bit. But they mentioned it, but it seems like they pulled back already on that.
We were very adamant that the strait would not be closed. And just looking at the fundamentals of who it would punish China, and that's about it. That would be the fundamental punishment, and China is one of Iran's only friends. And you don't really want to punish your friend and give ExxonMobil and Chevron a bonus. That's really not the way you want to play the game if you're Iran. Not to mention that both Saudi Arabia and the Qataris and I believe the UAE, they all have minesweepers, and that's really the only way that you could shut down the strait. The Iranian Navy is not something that anyone is overly concerned about at all. They do have a navy, but it's one that would pretty much be obliterated in about 2 days, and it might not even take the U.S. to get involved to do it. We were very unconcerned about the strait ever being closed, and if it did, it would just be a bunch of minesweepers from the U.S. and other allies sweeping it constantly, and it would almost be like just an annoying. It would be like getting bit by a mosquito. Like, you don't like it, and bug spray is annoying, but you can put bug spray on and still go outside. So it's very similar to that.
As an allocator, when we're thinking about international markets, where do you guys see the most attractive areas?
Ooh, the most attractive areas to us, and again, big on frameworks. We structure it as who are the allied trade partners, and who are the trade partners that if they weren't really important, we probably wouldn't trade as heavily with. So we divide it into those two buckets, and then look at who's most likely to benefit from what we do see as the potential for a significant structural change within the trading blocks. So we would be looking at places like Japan, India, South Korea. We think those three countries are vitally important to the pivot to Asia that the Trump administration, but also previous administrations, have been looking to do, and for some reason always get bogged down in the Middle East. But the pivot to Asia is very important, particularly on the trade front. South Korea, Japan, India, three very, very good allies. Japan and India compete on the technology front, but they also are heavy investors in U.S. infrastructure. Right. I like to tell the story of Toyota really doesn't care if they can hire an employee in Tokyo. They really care if they can hire an employee in Georgetown, Kentucky, where they hire and make a massive amount of Toyotas every year. So I believe their largest factory, and they're doing a significant expansion to it as well in the world. Suzuki doesn't care if they sell another motorcycle. Well, they do care, but they really, on the margin, don't care if they sell any more motorcycles in Japan. They're the largest seller of motorbikes in India, right? They care about places that aren't necessarily their own economy. So the demographics don't really matter to them. They're manufacturing motorcycles in India and bringing those profits home, and then giving a dividend to investors. So to me, I think those are very interesting markets that they get dinged for different things that I think are kind of first level thinking, right? Like demographics in Japan are horrible. Yeah, but that's not where they're making their money. They're making their money outside of their borders. When it comes to India, India to me is very, very intriguing. Largest democracy in the world. Modi and Trump get along swimmingly. They were negotiating a free trade agreement before Liberation Day. They have a free trade agreement coming online with the UK, with the EU, and they don't get along with China. So it's like the perfect mix of everything you want if you're trying to negotiate with the Trump administration on a trade basis, and deal. Hey, we're not really that friendly and have never been that friendly with China. We want to be friendly with you. Let us replace China as one of your major hubs of commerce. That is really attractive to companies like Starbucks, Nike, Apple, who all are looking at what's going on with their China business and saying, we have to replace this growth engine that was very good for us. The trade situation is not great for our brand, in China, right? If you're Chinese and you keep hearing about the US and China having a trade war, it's not really great for, do I want to go to my Chinese owned coffee shop, or do I want to go to the Starbucks down the street? India is different on that front. India is a place where, they get along with the US. You haven't seen the same headlines. They have more people. Their population is growing. It's young. And they are really beginning to have a consumer culture. So to me, India, of all the places in the emerging world, is probably the most interesting. Second would be Mexico, again, because of the manufacturing. Very good at negotiating with Trump. During the whole kerfuffle with Canada and the, hey, do you want to be the 51st state? hey, why don't you come to the governor's ball, Trudeau? That whole time that we were calling Canada the 51st state, he was calling out Claudia Sheinbaum, president of Mexico, as being a great leader, knowing how to negotiate and being a friend of the US. So to me, that's indicative of when you have somebody who understands how to negotiate with the administration, you're likely to get a better deal coming out the other end. So um, honestly, I'm going into July 9th, which is the deadline. It's an arbitrary deadline, but it's a deadline of that 90-day extension after Liberation Day. We call it Tribute Day internally. Because you're either going to pay the tribute or you're going to be a tribute to the Trump administration. They will call you out and punish you. So going into Tribute Day, we think there are going to be a number of deals that are either announced or frameworked or something that's just the positive, and then everybody can kind of move on. And then there's going to be some that really aren't that great. Probably China, probably Brazil. We haven't heard a lot about Brazil coming to the table. They don't really have a lot to offer, frankly, in terms of how we would negotiate with them. So I think you're going to see some be made an example of, but it's generally going to be a positive for the emerging markets and the developed markets, frankly, that the US is close to and has been talking to the majority of the time. Kind of luckily for Bessent, there's been other issues globally that have kept him out of the headlines. So he hasn't had to go up every Friday afternoon and announce some sort of either progress or not progress, et cetera. So he's been able to do it a little under the radar, which is a good thing, not a bad thing.
Do you expect them to get some sort of framework with the EU?
I do. Yes. Yeah. And it might not be comprehensive and it might not actually be that interesting. That's kind of my assumption going in on a lot of these, but it'll be enough that the Trump administration can call it a win and move on. And that's, that particularly after the 12-day war between Israel and Iran, I would argue that is going to be very important for the administration to keep the positivity going, right? They got a taste of, hey, we bombed Iran, oil went to $78, and now it's back to 64.50 or wherever it is at this moment. But that's kind of one of those things where they can claim a victory and they can keep that ball rolling, and it's only 2 weeks away.
Do you see, a lot of call it, maybe if we were to segment the markets, seems like you're pretty bullish on the emerging markets. Let's just say, developed markets, if we were to segment them, you see a lot of legs in those markets over the coming years?
Ooh, it's a great question, and I love it. So Japan, I think Japan is more of a steady state equity market in particular, where you get steady, probably above U.S. returns from here, including dividends. I think dividends are going to be a very important part of that return stream. And so on an after-tax basis, it might actually be more interesting than a lot of markets. When it comes to Europe, I wasn't all that bullish Europe. If we had done this call a year ago, I wasn't that bullish on Europe. I was bullish on Poland, and Eastern Europe, because they were really ramping up their defense spending, interesting demographics, and not the economic problems of their Western European counterparts. But those are emerging markets, to be clear. With the announcements of the defense and rearmament upticks, particularly out of Germany, I would say you have a significant runway for European growth that you didn't have a year ago. It's a very interesting scenario, and it's not just Germany spending, call it 2 trillion over the next 5 years. It's that they're spending that money in ways that are pretty interesting and aren't going to stay within the German borders. Germany does not have a significant defense industry. For whatever reason, from 1947 to 1987, they simply didn't have any indigenous military capabilities and defense industry capabilities. The world had learned a lesson and said no. Then the fall of the Berlin Wall, they began to slowly rebuild their defense industry, but they really only have one or two real investable companies at this point. The rest are in France, Italy, to a certain degree, Spain, not a whole lot in Spain, and some Eastern European and Nordic countries. So Germany is really stimulating the vast majority of the continent in order to be able to rearm themselves. Not to mention that Italy and basically everybody but Spain. Spain got called out by Trump this morning.
Yeah, I was going to say, didn't they? Yeah.
Yeah,
they're not hit their numbers.
Yeah, because they just didn't want to hit their number. Everybody else is hitting their number. Even the Nordic countries are hitting it in a pretty big way that I find to be pretty fascinating. The Nordic countries, by the way, are not to be trifled with. They have a lot of money and they have a lot of balance sheet capabilities. We kind of laugh at them, right? It's cold up there, et cetera. But Finland won a war against Russia not that long ago, and has a significant, has creativity when it comes to their defense industry. Saab, remember those really cool cars back in the 90s? That the car company is dead. It got bought by GM, and GM killed it. They also killed Saturn, two of the most fun car companies on the planet, both dead because of GM. But Saab is one of the best makers of cheap but very effective fighter planes and submarines. That's the part of the company that survived. Poland bought 5 submarines, I believe, for delivery. They're very good. They're very quiet. They're very useful. They're very fast. So it's going to be one of those longer-term stimulus packages that filters into the real economy. Not necessarily straight to the consumer, and stimulating the growth of the European consumer base, but a lot of technology comes out of defense spending. Arguably, one of the best things that ever happened to the U.S. in terms of technological development was the Cold War. Right, the arms race was really a tech race, and out of it came some of the most interesting technologies of the 21st century. And by the way, one of the more interesting things that got announced was Nokia on a secure comms deal. Remember Nokia when it was a kind of the cell phone company? Nokia making a comeback in secure comms would be one of history's great ironies here.
Now, obviously, one of the big questions I always get is China. We've touched on Japan, India, Europe as all being, certainly good opportunities, because when we've looked at allocations, I've had a lot of clients to say, why are we investing outside the US over the last 5 years? Because when they just look at the return profile, it's been certainly a challenge. How are you guys thinking about, China, given the AI race and, obviously the concerns about real estate, their population issues? Do you see them as investable again? And how are you guys allocating there, if at all?
So we're significantly underweight China, while being, I would say, equal weight to, in some portfolios, to overweight non-US broadly, with some emphasis on emerging markets. So we do like emerging markets, and emerging markets ex-China have actually performed very, very well. China has been a tremendous drag on non-US investing, right? And if you look outside of the U.S. right now, everywhere is basically smoking the U.S. this year. Even Mexico, I want to say Mexico's up something like 24, 25% this year. With all the trade stuff, you would think Mexico would get pounded. No. And Europe's done very well as well. When it comes to China, I think it's a difficult investment environment broadly. They have some great, they have great companies, right? The BYD, the car company, Huawei, they dominate in some pretty close to the U.S. markets, right? If you fly into Mexico City, I got picked up from the airport about a month ago in a BYD, and they drove me to my hotel, and it was a pretty cool car. Not gonna lie, quietly, it was way better than a Tesla, and kind of cooler. If I'm not going to lie, it was pretty awesome.
Yeah, I've seen those.
But much like Tesla, they're all sold at a loss, right? These things do not make money. These companies just They don't make any money. They tend to flood markets and they tend to overproduce, right? They have a ton of overcapacity because that's how you employ people. Like, hey, go get a factory job and we'll employ you. That worked for a long time when, call it before the rest of the world said, wait a minute, we also want to manufacture stuff. You can't just, dump all your stuff here. That's not how it works. So to me, it's a little difficult to get excited about a country that has a significant overhang from real estate. That is going to have to be resolved somehow. I thought that part of the way that they would get that done would be, if you think back to the S&L crisis in the United States, late 80s, we created basically a giant bad bank, stuffed all the bad loans into it, and then sold it all off to investors. Some investors did incredibly well out of that. In fact, some very large real estate companies that a lot of people respect today were built off of buying real estate for pennies on the dollar from the bad bank. But they haven't done that. So the loans are still there. The real estate overhang's still there. They're probably going to have to stuff them into their banks, and their banks aren't going to be able to loan out enough money unless they get a large injection from the People's Bank of China, their version of the Federal Reserve. To me,
do you see that happening?
Yes.
Do you see a scenario where that's going to happen? Yeah,
100%. And they're going to make the real estate investors take full losses, right? They're going to have to mark those down. They're communist. They're not going to be, they're not going to be giving handouts to real estate billionaires. On paper, they're going to be bankrupting them. But that has to happen before I can get excited. The consumer really hasn't picked up that much. And by the way, I never pay attention to the official statistics coming out of China. The best way to do it is look at Nike's earnings, look at Starbucks earnings, look at Yum C, that's KFC, Taco Bell, and Pizza Hut. And they spun out their China operations. It was actually perfect timing for them. They did it at the peak of Chinese equities about a decade ago, maybe over a decade ago. And it was brilliant. It was a brilliant move. But you look at those earnings numbers and they'll tell you same store sales. They'll give you all these details of what's going on the ground with the consumer. And you can even adjust a little bit for the anti-American sentiment that might be coming during a trade war. It's still not great. So until that consumer really begins to ramp up, I just can't get excited about a China allocation. And meanwhile, you have other emerging economies doing pretty well, beginning to potentially, have deals on the trade side that China is not going to get with this administration. To me, I want to follow the places that developed in a way that wasn't communist and top down, because I'm not going to have the problems that I will in China. So to me, I would say you can have I have a very, very low allocation within the portfolios that I'm the chief strategist on at the firm. I have a very low allocation to China within the portfolio, but it's all to the tech side, none of the state-owned and or banks that are out there, and focused predominantly on catching a tailwind if there is some sort of comeback of the consumer.
If you were to, maybe just for groups that folks in the call are not necessarily have worked with you guys directly, if there maybe are a couple funds that you really would be, under the WisdomTree, hierarchy that you are really excited about, whether it be like EPI or, it would be helpful maybe just get some context into some of those options.
Sure. So we're known for, not having just a straight market cap weighted investment products, but known for, really trying to keep it in call it a smart beta or a smart allocation type of way. So the ones that I'm currently excited about are DGRW. That's our dividend growth fund. I think that's an interesting place to be in the US. And by the way, I'm not negative on the US. I'm just more excited about some of the stuff outside of the US. Mm-hmm. I think it's an interesting place to be, partially because most of the companies that have exposure to tariffs, particularly within that fund, have taken down their earnings estimates for the year in a very meaningful way. and they took them down in the first quarter. So this is when China was 145 in terms of a tariff. This is when there wasn't a whole lot of clarity on whether or not there was going to be a 90-day pause in some cases. So their earnings estimates got absolutely destroyed. They took the hit, and now any trade deals that come out of in the next 2 to 3 weeks are going to result in those earnings estimates going in the opposite direction. They're going to go back up. They all announced plans to attempt to maintain their margins during this tariff scuffle. If they do that, plus have the tariffs come off, that's going to mean higher margins because they have likely laid off a significant, or not significant, but they've laid off and or cut costs outside of the U.S. Nobody wants to cut costs in the U.S. at this point because that is going to get you a Truth Social tweet real fast and get you called out almost immediately. So non-U.S. costs are being taken out of the system. You get those tariffs taken back down. All of a sudden, you're looking at better margins, an economy in the U.S. that's running between 2 and 2.5%, which is right where you want to be, likely to have interest rate cuts in the back half of the year. That to me is a really interesting spot to be. So I like DGRW from that angle, and you're not taking the big multiple risk, right? Dividend growers do not have the same high multiples as some of the call it high flyer tech names. But you still get some of the higher quality tech in there as well. EPIs is the earnings weighted India fund that I find to be very intriguing. It's an all cap strategy, and I think that's really important because we do get exposure to the small and mid cap companies that are growing, and we don't have to sell them. A lot of the cool stuff, like Nvidia, for instance, doesn't spend a whole lot of time in the small cap or mid cap indices. They jump to the large cap, and then all of a sudden, investors don't get the whole run. They just get the part of the success. It's interesting. In this complete side note, but it's one of my favorite little facts. Nvidia spent a year and a half as a small cap company in the S&P indices before it was promoted to the S&P 500. And the company that it replaced in the S&P 500 was Enron. I just love that little tidbit there. But if you had invested in the small cap indice thinking you were going to get some of the cool new technology and get exposure to it for a while, you had exposure to Nvidia for a year and a half, and then and I think it was an $8.5 billion company when it took out Enron, and then it went from an $8.5 billion company to $3 trillion. So part of the reason for designing it as an earnings weighted portfolio was they don't have a dividend culture, and we wanted an all cap structure so we weren't missing out on their versions of Nvidia or Apple, and could hold them for as long as they made money.
As we finish up, any other, I guess, are there any concerns that you have maybe internationally that could change your picture? You seem generally pretty bullish on the international markets, and sounds to be overweight, comparative to US. Anything that would, change outside of maybe some of the initial things we spoke about?
Ooh, so I do think it's very, very important to pay attention to July 9th. I think that is a pivotal day that's largely getting overshadowed by bombs at this point. Bombs matter. War is never a good thing, but it tends to be fleeting, particularly unless you have, call it a world war, in terms of portfolio relevance. When it comes to trade and tariffs, this is going to create some very, very big winners. If India gets a trade deal with the US, EU, and UK, that's, call it 70% of the global economy that they have a free trade deal with. That's a game changer for a country that really didn't have free trade deals at all a year and a half ago. Like that's a complete like step function change. It's really exciting on a number of levels there. So paying very close attention to who gets the trade deals, who gets the nod from the administration in terms of, hey, Walmart, you're allowed to procure from India at 10% or 5% tariffs. Don't worry about it. Go. John Deere, you're finally allowed to sell into India, which is a huge agricultural country. You're finally allowed to sell in there. Go for it. There's going to be a lot of winners coming out of it, and there's going to be a lot of losers. A lot of these trade deals are going to be about energy. LNG, for example, Japan, Korea, they're huge importers of LNG. They have large exposures to Russia. Trump would like to replace that, and a lot of LNG capacity is coming online in Alaska. So it's probably going to be a significant negative for Putin. It's going to be a very significant positive for some U.S. producers that aren't being paid attention to at this time on a pretty clean energy that doesn't cost a whole lot to take out of the ground. And has very long-term contracts. They're almost going to look like Visa at that point. And then I'm really paying attention to how much comes out of the ag side of things. China, if China wants a better deal than it has right now, they're going to have to agree to actually buy some ag from the U.S. Japan's going to buy ag. Korea's going to buy ag. EU's probably going to loosen some of the rules. India is going to loosen some of the rules. That's really bad for South America broadly. That's bad for Argentina on the margin. That's bad for Brazil. Very bad for Brazil. Brazil is kind of the incremental seller of foodstuffs into Asia. That's so there's going to be some big winners, but there's also going to be some big losers. And I'm trying to really pay attention to the who, what, where, when of winning and losing. And it's a moment where I think picking the right emerging markets is going to pay off very, very well. Picking the right developed markets is going to pay off very, very well. But it's not just a by the market cap weighted indices. EM is 50% China and Taiwan. I probably don't want emerging market cap weighted, but I want emerging market exposure in a significant way. So just being smart about it. And I think it's a really interesting time where portfolios that are well constructed and well thought out, like I'm sure yours are going to do very well over the next 5 to 10 years, even with all the angst that is currently out there.
Yeah, and with that, Sam, I certainly appreciate going through everything today, and I think that provides an excellent segue. I mean, when you get into international markets, active management is going to be key, especially too as we come up on some of these big market moving events in early July. So Sam, thanks for taking the time today to unpack all the craziness that we're dealing with. It's crazy to think that it almost seems like we've forgotten about the tariff day coming up here in early July, just with everything else going on. So it was really helpful to bring that to the forefront. And for folks on the call, if you have any questions, with regards to some of the WisdomTree product strategies, certainly reach out to me. They're an excellent partner and a resource. So once again, Sam, thanks for the time today, and I hope everyone has a wonderful afternoon.
Always a pleasure. Look forward to next time.
All right, take care now. See you guys.
You as well.
Thank you.